Let me show you something.
Silver and gold had another strong showing this week. Gold threatened with $1,300 per troy ounce. Although there was a bit of profit taking today in the derivative markets, the gold spot price is likely to close around the $1,287 per troy ounce mark. Silver is rounding out this week at about $15.87 per troy ounce. Of recent note on the show, palladium hit another record nominal price high today, eclipsing the $1,305 per troy ounce mark. This week's returning guest is coming up. He will be giving us some in-depth analysis with accompanied price charts covering the short to medium term setups in not only gold, silver, but also the greater U.S. equity markets. If you're simply listening to this podcast on your smartphone, be sure to check out our YouTube channel for the video version in order to see some of the current setups and ongoings in the financial markets we will discuss. Before we begin, a brief message from our show's sponsor. SDBullion.com is a high-volume physical gold, silver, and precious metal dealer. Founded in March 2012 with the goal of providing the lowest cost bullion available, SD Bullion has become one of the largest US-based precious metal dealers and is regularly recognized by Inc. magazine as one of America's fastest growing companies. Having now served over 100,000 customers around the world with over 10,000 positive online reviews, SD Bullion continues to gain industry market share by being one of the premier low-cost options for physical precious metal bullion buyers and sellers. At SDBullion.com, you can order your guaranteed physical precious metal bullion products online, 24 hours a day, 7 days a week. Discreet, low-cost delivery is both fast and always fully insured. You can also choose to purchase various qualifying gold and silver IRA products, which can be held in your individual retirement account for long-term wealth preservation. We are committed to being your trusted source for low-cost, highest quality investment-grade bullion products. Visit SDBullion.com for more information. Welcome to this week's Metals and Markets podcast. I'm your host, James Anderson of SD Bullion. This interview is being recorded at 5 p.m. Eastern on Thursday, January 3rd, 2019. With us this week is a returning guest to the show. He is Mr. Christopher Aaron of iGoldAdvisor.com and iGlobalAnalytics.com. Let me do that one more time. And iGlobalAnalytics.com. Christopher, thank you very much for taking the time to speak with us today.
James, it's a pleasure. Thank you very much for having me back on.
Oh, sure thing, Chris. Always a pleasure to speak with you and get an update on how you're seeing things in the markets. Before the interview started, we had a little pre-roll discussion, and it sounds like you've been pretty busy of late. The new website, iGlobalAnalytics.com, it sounds like it's going to be a little bit more than just the gold and silver and the precious metals markets. So if you could, just give our listeners a little bit of an idea of what you're up to.
Yeah, thanks. So the reason why this all started, and I'm someone who back in the mid 2000s, I began my study of the precious metals from the fundamental standpoint and really understanding, and it really appealed to me on a deep level. And then I observed certain things through my experience with the metals, such as during the crash of 2008, and then the decline, which began after 2011, which just showed me that we have to really pay attention to what the market is actually saying. And those fundamentals are driving the market over the long run. But over the short and the intermediate run, these things can really move in contrary directions to what we might perceive. So, shouldn't we pay attention to those things? And so when we look at the first chart, if we can pull up this first chart here, we're looking at the S&P 500. This is the largest index of the 500 largest companies in the United States. So we're talking about the stock market. And we're looking at this as a ratio to the price of gold. And let me discuss this just in one moment. But the new site, iGlobalAnalytics, which is coming up, is based on a derivative of the fact that in my own analysis of the precious metals, I saw how related all these different markets are, and there are times where stocks are moving counter to precious metals. There are times where all of these markets are synchronized. And I just found that it really improves my own awareness of the metals to be following all these different markets. So that's what we're going to be doing on the new site, is focusing on some different markets. Bringing it back to the chart that we're looking at right now, S&P 500 to gold. If you look at where this ratio started, near that 5.6 level going back, and that corresponded with the dot-com bubble in 1999 and 2000, and then the outperformance that we saw of gold, all the way from 5.6 on the ratio all the way down to 0.6, at the peak in 2011. So stocks lost almost 90% of their value relative to gold over those 10 years. That's what this ratio is showing. And now, since 2011, we are in this sort of counter trend. It looks like at this point a counter trend rally. You can see that by the blue line right there. And just notice where this rally, in other words, stocks are outperforming gold since 2011. Notice where that rally topped out just a few months ago, October of 2018, right at that level, that strong resistance level, the black line, which goes all the way back to 2002, 2003, and then it acted as resistance in 2006, 2007. So we're seeing a test of this level. I mean, literally as we're speaking, the level closed at 1.9. And I would say if this ratio can break lower through what has served as a trend for the last 7 years, it's going to tell us that the next period of precious metals outperforming stocks has arrived. And that will be, for anyone who has suffered from 2011 through the present with the metals, that will really be a sea change. So there are the levels right now. However, if this holds, if the present level holds, and we kind of, grind our way back up into that 2.5 region, then we have to look at this real objectively as metals investors and say, is there still a period of underperformance to come here?
For sure. Yeah, it looks like, if it doesn't break through, like you're saying, and it bounces off this blue line, you could have another year or two of lingering before, one move happens one way or the other. It's tremendously. And just the point about the fact that we're measuring this in gold, I'm sure you're fully aware of the fact that fiat currencies are always measured against one another. So when people bring up, strong dollar, when you hear that kind of tossed around on like CNBC or any of those types of financial shows, essentially what people are talking about is a fiat currency US dollar versus fiat currency euro and yen and pound, et cetera, et cetera. So you may have one going up versus the other, but they could all be losing value to real world goods and services.
Yeah, that's exactly right. And I wanted to make the point. So as we're looking at this chart of relative asset classes, and for example, depending on how this works out here over the next year, we may be looking at a stronger or a weaker trajectory for the metals. Then when we get into that topic that you just brought up, currencies versus currencies, I want to make this known, for public record. When I'm saving, no matter what gold is doing versus stocks, but when I'm saving my purchasing power, and we're talking a savings account, I save in gold. That's how I do it. I don't save my money in a fiat system, and that's pretty much no matter what the price is. I consider my gold as my savings account, but also I'm willing to use my gold when there's a good opportunity. If I want to buy a home or a chunk of land, depending on the valuations of those asset classes, I utilize my savings account. So I don't see it as independent that we can be looking at the price trajectories for gold, and we'll see how that works out. And even if that were to be falling over the next year, I'm still willing to save my money in gold because, as you said, the dollar comparison with other fiat currencies is not an accurate standard.
Right. And we live in a world right now where I look out next 10 years and it's like, are real interest rates ever going to be like they were in the 1980s, well above the real inflation rate? I don't think so. Not with not with the debt levels and the unfunded liabilities that we have. I think they'll just keep lying about the inflation rate and underpaying people for keeping their cash in a bank. So
Absolutely. How can they? How can they ever afford to pay? Look at the volatility. Look at the 20% drop in stocks, which was caused by just a moderate increase in the interest rates over the last 3 years. And then let's imagine those interest rates were to get back up to levels in the 90s, as you said, or even going back to the 70s or 80s. How could the debt load be sustained? It can't at that level.
yeah, so it's treating physical gold as essentially cash is essentially what we're doing.
Exactly right.
Well, let's see. What's the next chart? You had S&P 500 index.
Yes, exactly. So this is the point that I want to make as we're looking at that. We were looking at the ratio before of gold to the S&P 500, and now I want to take the listeners through a series of just a few slides here to focus on the stock market. So we've already made the case about the relationship between stocks and gold, and now let's look at the numerator, of that ratio, the S&P 500. And look at this, it's in the magenta color in big, bold writing, the orderly linear rising channel that began from the crash low in 2009. And look how this level, coming up here into late 2018 was just tested a week and a half ago. I think this was Christmas Eve where that was just tested at 2346, I believe was the low, right on that line. So look at how this market is moving in such an orderly, kind of way. And it made that attempt, you can see in the blue, the attempt to blow off in a mania, and it failed. Mm-hmm. Now, if we start, the point that I want to draw to listeners here is that we're looking at a lot of fundamental valuations. If we were to pull up the dividend yield on the S&P 500, it's at generational lows, which is showing that the stock market is overvalued. If we were to look at other indicators like the Buffett indicator, the total value of all the stock market versus the GDP of this country, that's at a generational high, the second highest reading ever. But there's a big difference between whether or not something is fundamentally overvalued and whether or not the market cares, and whether or not the market is just going to continue acting irrationally for a period of time. And that's why I wanted to point out to the audience here where we are. We see that we're at that lower trend line, that lower level, just above 2450 now. And if we move on to the next series of slides, we are going to look at a historical example of how this similar pattern set up in the past for the S&P 500. So the next one we're looking at is the same index, the stock market, from 1981 through 1987, and we're showing there the crash of 1987. Now, if you were not participating in the markets at the time, just know this, that this crash was over a 25% decline in the stock market, and it happened not in 2.5 months, as we just saw here in our recent example, but over 3 weeks. So in 3 weeks, the stock market lost 25% of its value. That's shown right there. But the point is to, and there were a lot of people who are a lot smarter than I am. I have gone back and watched documentaries with Paul Tudor Jones, famous hedge fund manager. And after the crash, in that low right around 220 on the S&P 500, Paul Tudor Jones was coming out and saying he thinks that's going to be the crash of 1929, to make a similar analogy. But notice, so the technical point, what we're looking at here is that we can have these beliefs, but notice where the market held up. And we had that sort of double bottom in October of 1987, and then a couple months later, making a functional double bottom. Notice how the lower channel of that rising trend, which began in 1982, notice how that held, right? And that's very similar. It's quite striking how similar that is to the present moment in stocks. And so just fast forwarding now to the next chart, we can see it is mind blowing sometimes. We can see that when the lower boundary, and now we're looking at the same S&P 500 index extending that same chart. The last chart ended at 1987. There was the crash of 87, looking on a linear scale. It looks rather insignificant uh, because we see that when that lower boundary, and all we're talking about here is what is the market actually doing, versus what would the fundamentals dictate. But what is the market actually doing? It held, and so it proved Paul Tudor Jones and a lot of hedge fund managers who were short after the 87 crash, it proved them wrong. And it just continued to grind its way higher and then made another parabolic advance in 95, which led to, something that would have made the 87 crash seem, rather insignificant in the long run.
Yeah, it's just going back to that S&P chart that from 2009 to today, that thing literally looked like the gold chart from 2001 to 2011, essentially. This chart here, this S&P 500 index from 81 to 2000 looks, just bonkers. And for anyone out there listening, the dot-com bubble is, I believe, the highest, in terms of stocks priced versus gold in any chart I've ever seen. And going back 200 years in the United States, we've never had a stock market that overvalued. And when you look at sometimes the 200-year chart, it's kind of interesting. I might inject it into this conversation just so people can see it. It almost looks like we've been sitting in a dead cat bounce in terms of gold based off of that 2000 high. We've bounced off it, and it looks like, if it does roll over, there's a lot of room down, essentially, is what I'm saying. So, Chris, your points are valid. This 87 crash, obviously, we had people probably who thought, we were headed back into a Great Depression, and that was not the case. The demographics at the time were extremely good, and the United States kicked butt from 87 up to 2000. Look at that market. It was very orderly, rise in value. And then obviously the parabola started in about 96 up to 2000. So you had that dot-com bubble kick in.
Exactly. So, it's like, where are we on that former model, which looks, quite similar? Where are we? We are, as you said, it's quite a similar model also to the 2001 to 2011 gold model. But the technical takeaway here is we have to see that lower boundary of that trend channel break. And if that happens, it's right on the line right now. So I would say there are times, and this is me in my own work speaking right now. There are times where I have to admit that I don't have the prediction. I don't have the answer right now. What I do have is, where are the boundaries where if we see a break below a certain level, then we have the answer for the next period of time that's coming forward, So we're at that point right now that we want to monitor.
I would imagine the monitoring that you're looking at, you're talking about within the next quarters, maybe to a year, and you'll have a clear direction you think it'll go.
Yeah, exactly. Especially if we go back to that original chart, the S&P 500 to gold. This thing is going to break higher or lower strongly in one way or the other within the next year to 18 months. This is not going to take 10 years for us to know what's happening here.
Good, because this is getting long in the tooth. Yeah. Just kidding around. Okay, so you got a silver chart here. It looks like we should bust that out if we can.
Yeah, and then we have the long-term silver chart. And so I wanted to say the gold model, the specific gold chart itself, we're reworking that at the present moment because we're seeing a lot of conflicting data. Relative strength with the mining complex is weak, whereas gold has just recovered a broken trend dating back from 2015. So we're seeing a lot of conflicting data. There's an updated gold chart that will be coming out over the next couple of weeks. But silver, the lines are still more clear that I'm looking at. We're looking at that very long-term silver chart. And I just wanted to sort of bring up that silver is at a critical confluence of resistance here, coming, where are we right now? 1570 or so on the spot. and if you look back at the history of silver from the 2015 low, that low at 1365, and then the surge up to 2125. The entire time, this market was above that long-term rising trend dating all the way back to 2003. And in fact, in 2015, it bounced almost exactly at that level. After it broke, you could see the turquoise color there, that little sort of converging wedge pattern. And this is why I started publishing research on the precious metals in late 2015, is because I was convinced that we were going to have a sizable bounce from that long-term trend line. That one ended up working out well. What we saw in 2018 was a break below that trend, unfortunately. Now, markets can give false signals sometimes, and patterns change all the time. But at this point, what we do see is a strong confluence of resistance in the silver market between this upper 15 level and then that upper blue band, which connects the declining series of peaks dating back to 2016. So in the upper 15s to, I'll call it 1675. And it seems like a wide range, short term, when we're talking about silver oscillating between, 14 and 16 over the last couple of years. But really, in the grand scheme of things, that upper resistance level at 1675 is only a fraction away compared to where this market could go. And so what I'm saying is the bias at this point would be that silver should encounter a lot of selling pressure below 1675. That would be the bias in my highest probability. And it would look to have to base out, over the next year, and then we'll talk about what happens later this year. But I would say the level is clearly defined. And so if we can see silver overcome the confluence of these resistance levels, and especially that 1675 level, and let's say that happens halfway through this year, 1675, I will become very, very bullish again on silver, not just over the long run, which I already am, but over the intermediate run. So I'm just showing the levels that I think investors should watch, which will tell us whether or not this market wants to take the long-term approach or the short-term sort of accelerated approach.
Yeah, 2 points to follow up. You did come on this podcast in June of 2018 and pretty much nailed the call that silver was going to go lower, or it had to do something. It had to either break higher or go lower. And you were more bearish in your tone, so I was not surprised that you were proven correct in your sentiment and the fact that we had that plunge in the spot price over the summer and early fall. And then the second point is, yeah, this 1675 does seem like real resistance. If it can somehow get through, my hunch is there'll have to be some other thing that drives it. But if it happens, then great. We don't have to wait as long, and maybe we'll get some upside action coming in shorter term. But if it bounces and rolls over, it feels like we're starting to get backed into a corner here within the next year or two. No matter what happens, it should start to play out for precious metals. That's at least how I feel as an investor.
Yeah, and it's a great time to be alive, be watching these things, especially at extremes when we're looking at the fundamentals with the stock market. And then we didn't even touch on the bond market, which is we're talking historical low interest rates that are just rounding out. It's not that the last time that we've had something like this really is a period in the late 60s and early 70s. And we know that led to the bull market in precious metals throughout the 1970s. It can take a few more years sometimes than we wish that it would, but I'm just saying that it's not that often that you get to live through markets being at such extreme levels like this. So, it's a great time to be an investor, but also a great time to be a student. I think if you're like me and like you as well, James, I know because we've talked off air about this, but if you love to study markets in general, I just think it's a wonderful time to be a student of these markets.
Yeah, and we're real lucky to have you as a resource. I mean, I thoroughly enjoy and can't suggest strongly enough for listeners to check out your YouTube channel, iGoldAdvisor. I just watched this past week one of your videos where you were talking about your new website and giving the listeners the chance to thumb up or thumb down. I mean, that was a pretty interesting social experiment.
Yeah.
I mean, I thought that was pretty funny. I'm like, wow, he's got a lot of likes and a lot of dislikes. And then I figured out why. It was pretty funny.
And the vote was almost nearly split, but there was a slight edge, just to be democratic about it, a slight edge to the pros. And so, we're going to be covering some new markets. The primary focus will remain precious metals, but we'll look at a lot of correlated markets as well going forward.
Yeah, and then just to let listeners know, obviously your iGoldAdvisor is the free YouTube account. You do have a subscription service, and you were so kind to give me a complimentary pass to go check it out. And when you send out your subscriptions, you send it out in email form. I always try and find 30 or 45 minutes during the day to steal and get over there and check it out because it's thorough. It's really good. You do really, really good jobs, not just in precious metals, but in all markets. You bring up some really key points and key things to consider. So I definitely enjoy your work, and that's exactly why I have you back as many times as I can. So thanks so much for doing that.
I really appreciate it, James. And just so you know, I never claim to have the crystal ball, but what I do claim is to be someone who studies these markets day in and day out, and I really try to look at it from a critical eye. I try to be as unbiased as possible, and that's about the only thing that I can claim.
Well, Christopher, I appreciate you coming on the show, and for all you listeners out there, how can they follow you, Chris? What's the easiest way for them to get you?
Yeah, so they can go to the website. The precious metals right now is iGoldAdvisor.com, and coming in 1 week, we will have the letter I and then globalanalytics.com. They can check out both of those, and they can also find me on Twitter or send me an email from either of those homepages, and I love to hear from anyone who wants to write in.
And one more point, I heard you're going to the Vancouver Resource Conference. Is that correct?
Yeah. Thanks for bringing that up. So I will be speaking on January 20th coming up, which is the Sunday, the first day of the Vancouver Resource Investment Conference. It will be about the resource markets and also about identifying patterns that repeat over and over again across all these markets.
Well, I hope there'll be somebody there with a recording device and good audio so you can get yourself a video for it. I would love to see that.
Thank you. Yeah, I hope so too.
All right, Chris. Thanks again.